Hey everybody, it's Mike from Order Flows, and welcome back to the Order Flow Blueprint. This is Module 2, How Trends Begin and Develop. All right, so one of the most useful applications of order flow is in trend analysis. And when you know what to look for in the order flow, you can determine when a trend is ending, beginning, showing strength or weakness, or simply not trending. Order flow allows you to see in real time as a trend develops or is peaking. And if you're just looking at your normal candlestick chart or bar chart, it's nice to look at the chart and see, oh yeah, the trend reversed down here and then it rallied up, then it reversed up here. Really what you want to be able to do is identify, what's taking place down here as it's happening to catch this potential move up, or catch what's happening here in the order flow to catch this move down. Because what order flow is going to allow you to do is get in as early as possible into the trend, so that you're not, you relying on some technical indicator and the market's already moving down and, you've missed the first quarter of the move. Really what you want to be able to do with the order flow is identify in here as the market is reversing, right? That's going to allow you to catch the majority of the trend. And when you look at the order flow, when you know what to look for, is going to help you identify as soon as you peak out up here at this high that, hey, you know what, there's some reversal activity taking place, and that's, a big part of this course is identifying the reversal so that you can catch the trend as it's starting to develop. And what you're seeing here, right, when we hit this high, right, obviously market found liquidity up in here. You can see the volume that's taking place up here at this high, 12,000, 8,000, 7,000. You can see the volumes in the footprint, 1066, 800, 872 up here. Now you're starting to see the aggressive selling coming in, in the footprint, right? Point of controls closing down on these bars. And then you're starting to see the momentum pick up, right? So when a trend is ending, you start to see the change in the order flow from bullish order flow to bearish order flow. And then when the trend is starting, you're going to start to see the momentum taking place, as you see here in this bar. And I'm going to get more in depth on recognizing the momentum in the order flow in a later module. But you can also see the momentum taking place here. Just spoiler alert, it's that lack of volume in the bar. Generally, bars are going to have volume pretty evenly distributed, right? You're going to oftentimes see the heavy volume appearing in the middle of the bar. But when you start seeing, volume leading the way down in the bars, that's a sign of momentum in a direction, as well as the lack of heavy volume. And remember, if you're looking at, a heat map or a book map, you're just concentrating on the areas of heavy liquidity. You're leaving out the areas of lack of liquidity or small liquidity. So ultimately, what really causes trends is, the big players, the long-term traders whose size is such that will move the market. And when they start coming into the market, that's when you got to start paying attention. So again, we are coming down in here into the low of the day, right? Now big traders are coming in. What's one of the signs of big traders is heavier volume. Hit the low of the day, 6,000 contracts. Next bar, 5,000. A bar later, 5,000. A couple bars later, 5,000. A few bars later, 6,000, 7,000, as this market is starting to move up. Because what happened is the big players, the ones that have the size that are going to help move the market, need to come into the market. They need to be coming in with size that's going to move the market. Okay, so you have more volume coming in as the market is starting to rise. Again, what's another sign? One, obviously heavy volume. And when you start getting heavy volume, you start to see the market looking for liquidity. As you can see here, right? The volume, 6,900. Do you see any volume like that anywhere in here? No, I mean, you're seeing 2,987, 2,938. 2,400, then it basically doubles, almost in some cases over triple the volume all of a sudden. And you have that aggressive buying coming in. You have that lack of in this case, a lack of aggressive selling, the very thin volumes, the 202. As the market starts working its way up, it finds liquidity sort of outside of this range that we had been trading in, comes back in to test it. More heavy volume comes in, 5,000 contracts. Obviously, this bar here with 11,000, but the market's already moving. This was your sign here of the trend potentially beginning. The big traders coming into the market thinking this market is bottomed out for wherever we're trading at. 41.23, we're basically trading between 41.29 and 41.23, for about 20 minutes, close to a half hour. Now all of a sudden the big buyers are coming in saying, hey, you know what, this area offers us value, and we're starting to take it higher. So what is important information to an order flow trader is noise to longer term traders. You often hear traders always saying, that's just noise in the market. Okay. But when you're reading order flow, you start to pick up these little nuances that are taking place. Oftentimes it's taking the place because of the bigger traders coming in, right? And when analyzing order flow for trend development, you are often looking at the market when things have quieted down but are now starting to pick up. Right here we have a nice quiet market, right? This is just sort of opposite of the chart that I just showed you where the market rallied, but we're trading in a nice range. And all of a sudden you see, you do have a couple bars here with some heavier volume, 5,200, 5,000 here, 4,000. All of a sudden it really picks up here, 6,000, 8,000. The traders are starting to come in, right? It's coming in as we're breaking out of sort of this range here. You can see the aggressive sellers coming in. Volume is migrating lower in each bar, right? We're closing each bar near the lows of the bar, right? As the market's going down. I mean, you got every sign in there, right? You've got the negative delta, you got the point of controls going lower, you got a lot of selling imbalances coming in, and you've got heavier volume, right? So out of quiet markets that look like it's just going sideways, nothing's happening, is often where trends develop from. And one of the clearest signs, obviously, is an increase in volume, because now you have more traders coming in and saying, hey, you know what? This is an opportunity for us to get long or get short, all right? And then when they are aggressive, right, it's going to show up in imbalances. It's going to show up in the delta. And ideally, you want to be seeing the volume migrating in that bar as well. If it's going down, you want to see the volume migrate lower, meaning the point of controls migrating lower, or market's going up, point of controls migrating higher. Now, short-term price movements are not trading in a vacuum. They are caused by bigger macro activity in the market. So even though you're looking at the market on a short time frame chart, it doesn't mean you're following short-term traders. People always think that everyone's looking at the same chart. No, we all look at different charts. Some traders, like myself, I use a 1-minute chart, I use a 30-second chart, I use, 50 tick, 100 tick charts. There's other traders that use 3-minute charts, 5-minute charts, 15-minute charts. We all use different charts. We all have different time frames. Okay, so when you watch a short-term chart, you're going to get a more granular look at what all time frame traders are doing. Okay, so even though you're looking at the market on a short-term chart, doesn't mean that you're following short-term traders per se. Because again, you could be looking at a 1-minute chart. Doesn't mean everybody else that's trading is looking at a 1-minute chart. No, everyone's looking at it from a very wide range of charts. So, when you start seeing things pick up in the volume, right? It's because, even though I'm looking at it on a 1-minute chart, if this was a 5-minute chart, it may not be able to pick up that increase in volume, because maybe this increase in volume, this increase in activity of trading is coming from people looking at a 30-minute chart, maybe even looking at a daily chart. So by looking at, the shorter time frame, it gives me a more granular look at the market. Okay, I mean, you can see here, right? This volume is off the charts, 1,400. It's not because people are looking at a 1-minute chart all of a sudden want to get short. It's probably because it's the longer term time frame traders coming into the market. And what's important for us as order flow traders trading on the short term is recognizing that big jump in volume and what's taking place. Well, not only is we got a big jump in volume, but big jump in aggressive selling, right? We see the big imbalances in the bar. We see the strong negative delta. We see the point of control coming in at the low of the bar. So one of the ways trends start is when a market is searching for liquidity, and that's a sign of things to come. And this is valuable information, right? Markets are moving because they're looking for liquidity, right? Maybe they were in this area. Everyone was happy to trade back and forth. Everyone thinks, well, the market's found its liquidity, it's found its balance. Yeah, it is. But now as it breaks out of balance and it's looking for a new balance, it's looking for liquidity, right? It's looking for that liquidity, that area where people can transact. It's coming out of an area that was balanced. That's where the imbalance is, right? That move away from balance, right? You got that imbalance coming in here, and it's looking for a new balance. So what are the signs the market is searching for liquidity? Well, you're going to see elongated bars, right? The longer bars like this, right? You see it here, right? The market has got pretty stable movement, okay? Right, you can see it coming in right in here, right? These bars are pretty much equal. All these bars here. Now you're starting to see it come in here, stretching out. Market's looking for liquidity. You see it's putting in new liquidity here, right? And then obviously this one is up off the charts as the market keeps searching for that liquidity. So taking advantage of a trend ending means you have to think outside of the box of retail herd mentality. For example, where should I buy when everyone seems to be selling? You'll study, think, try. That's how you're going to find your edge. Why should I be buying when everyone is selling, right? Everyone is selling. This market is moving down. Everyone's selling. Obviously, red bar, red bar, red bar, red bar, red bar, right? Lower point of controls. It's stopping here. Now, even though you can see the 3 point of controls, you do have some liquidity coming in, but you still have people selling. That's why you have the point of control down here. So if you start turning the market, looking at it from a different angle, maybe you think, hey, now this could be my buying opportunity, okay? Market's found that liquidity. It's found its balance. Now once it finds its balance, it's going to start moving, looking for a new balance in another direction. And you can see it here. Finally, you get that elongated bar up with lack of volume as the market is moving up. Again, everyone is buying. Coming up here to the high of the day. Why should you be selling when everyone's buying? All right, you got to start putting those pieces together. Right? Market's going up. People are getting excited. If you could look at the order flow, well, you could see even though the market is going up, what do you see? Negative delta. So you know that even though the market's going up, you still have aggressive selling. Market's going up on that aggressive selling. So it's telling you two things. One, you have supportive buying coming into the market. But more importantly, we're up here near the high. When you see supportive buying coming in, right, in the sense of a green candle with negative delta, ideally you want to be taking those lower, right, before the move is over, not as a move is, underway and going in a direction, is sort of peaking out near the high of the day. Because what is happening is when you get up near the high of the day is a structure point. And if at that structure point you have strong selling coming in that's being absorbed by that passive buying, people are getting out of a position. They're distributing their position, because the easiest way to distribute a position, at high prices is to sell into a rally. Okay, so even though you're thinking, well, everyone's buying up here, yeah, but you got big sellers coming in selling, because when you can recognize that it's not just, I got strong aggressive buying going up in here, but you got a big sellers coming in that are selling it on the way up. The market is telling you that it's potentially, this trend is probably going to end at some point pretty soon. And then once you see it sort of peak up in here, then you see the aggressive selling coming in here. Okay, so your sign, why you or me should be selling when everyone is buying, right? Everyone is buying on this way up, right? Obviously, you got green candles. Market is going up, but you have strong selling, and this is institutional selling, not retail selling. And that's the difference, right? If you could understand that in the sense that institutions are selling, that's what you should be doing too, right? Not buying because retail is buying. You see prices going up, right? Institutions are selling as this market is going up. They pause. You see the tops of these bars, thin volumes, 4, 5, right? 18, 3, 11, 7, right? As the market's going up, strong sellers are coming in. Then they're pausing. Let the bars drift back up, sell some more. Let it pause, sell some more as it keeps going up. Finally, the aggressive, the retail buying is drying up. Now the people that were selling here, right, on this way up, they start selling a little bit on the way down, seeing if they can still be absorbed by the buyers on the way up. But instead, they're overrunning those buyers. And you see this bar's got 4 imbalances in it. Right? And you can see very little counter trade. So, now they're getting more aggressive. You could be aggressive on the way up because the market's rallying. But once the market starts going down, it's not showing up necessarily as selling imbalances, just showing up as almost regular volume. But on the way back down, that same selling that was taking place on the way up, that aggressive selling, is showing up as selling imbalances. Now, the way PMs, PM is a portfolio manager, trade is different than retail traders. Now, forget about the size for a moment, because PMs, they trade big size in the market. And when a PM is thinking about a trade, it can take them a while to make a decision to get into the trade. That's their ideal time to enter. But once their decision is made, they want to get into the trade as quickly as possible and effectively as possible. That is when they're most aggressive. When they start adding to a position, they're not as anxious to get into the trade. Aggressive buying basically followed by passive bidding. Okay. So when a PM gets into a position, right, aggressive trading followed by passive bidding. What does that mean? Well, on a footprint chart, this is what it looks like. Right, now remember, trying to identify a trend. Okay. PM realizes, hey, I want to be long silver. They're going to be, just get me in. Try not to move the market too much, but we're sort of breaking out of this range, around the 1882 level. You start seeing some signs here, right? The aggressive buying imbalance. Then he's like, market starts ticking up. I got to be more aggressive. More buying imbalances come in. Now you're starting to see the passive bidding follow in, the 50 lots, the 41 lots, the 54 lots. That's the sign of institutional trading, right? It's not just one way. I see people say, well, institutional traders, they only use market orders or they only use limit orders. No, they use both, right? It's not just one or the other. It's a combination of everything. How do I know? Because I was that institutional trader for close to 2 decades. All right. Here, right, you see this market, it's just hanging around up here near the high of the day. You see in the aggressive selling, when you're at the high of the day, again, very structural point, high of the day. Right? You're seeing some strong aggressive selling coming in here in the sense of selling imbalances, right? Market's not really budging, which is good, right? That's what, if you're a PM, or you're a big trader, you don't want to be moving the market. You want to sell as much without moving the market. That's your goal. All right. But then once the market starts moving, you're going to get a little bit aggressive. You want to sort of trail it in with some offers. You can see here the 335, the 468, the 328. Because, once it starts breaking out, I'll say breaking out, but, testing the lows of an area, people, that's responsive traders, right, should be coming in, see if we can move it back into the balance. So they're going to work offers in here. And you see the market starts breaking down, right? Where's the stronger offers? Well, where's the stronger offers? Where's the stronger volume? They tend to be on the offer side here, right? That's what you want to see as the market is moving down. 671 here, 435, right? 266. Okay, so the heavier volumes are coming in here right before the market breaks. Now, big traders with big orders tend to avoid price discovery because when they go to execute their orders, they can impact prices. Think of it like trying to thread a needle. You need a very thin string, right? If you try to thread a needle with a shoelace, it's not going to go. It's not going to fit. And that's why big traders cut up their orders into small, tiny lots. And this is done so traders following a tape don't see 100-lot clips going through because, if there's algos out there that will pick up 100-lot being traded, 100-lot clip going through on the tape, and it'll do something because of it. That's why you see, 5 lots, 7 lots, 3 lots, 1 lot, etc. Nowadays it seems mostly 1 lots, but with order flow, that aggregate volume shows up in the footprint. So remember, if a big trader can start moving size in an area of structure, that's the ideal location for him. If we're up here near the high of the day, that's a structural point. It could move some size in here without moving the market. That's the ideal location for them. Okay, you can see here, right? They're selling it, right? You see these imbalances. It's not really moving the market. Volume pretty steady. Then you can start seeing they get a little bit more aggressive coming in here as we start breaking out, right? Then they're going to start trailing it in with the passive offers. So sometimes that often gets lost on order flow traders is that institutional order flow isn't always just one-sided. Okay, it's two-sided most of the time. Right? If institutional order flow is one-sided, all you'd see is buying imbalances followed by selling imbalances. It takes two to tango, it takes two to dance, right? And you often have, aggressive buying and aggressive selling sort of taking place. It's, you're really looking for, who's sticking their neck out in front and sort of get nearer to that finish line. But what you want to take advantage of is recognizing when it becomes one-sided, either because one side pauses or one side completely dominates. And this is where trends are going to start. Okay, coming down here, right, you see it's strong aggressive selling, obviously in the deltas. That's one sign. Point of control is going lower. Now it starts changing down here. Right, this trend is ending. Okay, you got the strong deltas. Okay, now you got strong positive deltas. Here was strong negative deltas. Now you're starting to see volume migrate up. Here on this move down, mostly selling imbalances. Now it's mostly buying imbalances, right? This trend has ended and now it's starting to shift, going in the opposite direction. The one nice thing about big money is it's often a catalyst for prolonged trends in the market. Okay? And, when, I don't know if you guys have really thought about, why trends start and continue. It's because the big money keeps coming into the market, right? It's not just because of retail traders coming into the market. No, retail traders won't be sustaining that move. You need bigger traders and bigger traders, I'll say, and bigger traders. You see more bigger traders coming into the market to help keep that move going. One way is obviously looking at the volume. You've got this move up, and you see some nice volume coming in here, 500, 800. That's one of those things of Dow theory, right? As a market is a healthy move, requires healthy volume, right? You see 800, 1,000 coming in, but also, right, watching in the individual bars. Is volume going higher? And when I mean volume going higher, volume at price. That's the point of controls. Okay. Obviously, you want to see buying imbalances. That's a sign of aggressive trading taking place. Obviously, you want to see positive deltas. That's a sign of aggressive buyers over aggressive sellers on a move up, or if the move was going down, ideally you'd want to see negative delta going down. It doesn't necessarily have to be increasing, but sustained. And you are going to have those periods where you get, a couple red bars coming in. It's not the end of the world. Then you start seeing the aggressive come back, volume coming back in, because what's happening, right? The aggressive long-term traders coming into the market starts buying, 106.94, 106.95. Oh, shucks, I pushed it all the way up above 107.05. I better pause. Okay, market comes down, starts going back up. Okay, now I can get aggressive again, right? And go back up. Because, if he didn't pause here, next thing he knows would be trading, instead of trading 107.06, would be trading 107.15 already, right? You want that little bit of a pause. Let, other traders come in and sort of fade his move. It's all a game, right? They're saying, okay, let me trick him into thinking I'm done. Now I got you again. Okay, big money often equals big size. Obviously, right? It takes a lot of money to have big size in the market. It's not like people can, you and I can trade 1,000 lots, right? It requires a lot of money up front in margin. So when you see obviously big increases in volume, there's longer term traders coming in, right? I mean, here you got this bar, 17,000 contracts. Previous bars, 5,000, 3,000, 5,000, 8,000, 6,000. Here was 9,000. So you know that you got bigger volume, you're attracting longer term traders, right? People that are probably going to have more of an effect on the market than you and I. This bar is not going to happen if it's 4,000 contracts, right? Market's searching for that liquidity. Now, big players trade their big orders in the market very carefully. And this is especially true in smaller markets. With the exception of treasuries, most markets in their current form are designed for the now enlarged institutional trading that's taking place. And, I remember when, gosh, it's dating myself, but, back in the days of the trading pits, remember when they had the first million contract day. This was back in the 90s. This was all the contracts and the CME volumes put together, euro dollars, the whole strip, combined with all the currencies, the equities. That was like a big thing. Now, you come into the morning, MES has already traded 1 million contracts by the time the cash opens. And, a lot of contracts before just didn't trade the volume that they're trading nowadays. Okay, so markets are more designed for medium to large institutional investors, and of course retail and hedging traders. So when you're the point I'm trying to make is, if you're trading smaller markets, sometimes reading the order flow is easier. And this is why I like to look at smaller markets, because I don't want to say it's like shooting fish in a barrel sometimes, because it still can be a little bit difficult, but smaller markets, you could see what the larger players are doing. And when you're on smaller markets, you're really only dealing with a handful of traders. I mean, not a handful of traders, but a handful of institutions that are trading it. Right? You don't get all that hot money coming in based off of zero expiration option, zero date options, things like that. And it's going to affect the move. So I don't say there's less shenanigans going on, but there's sort of less outside factors other than the big traders that are moving the market based off of the fundamentals. And in case you're wondering, look at the grains, look at the meats. I don't say look at the currencies, but those are grains and meats are the agricultural contracts. You don't get the big, there are hedge funds that have, that do specialize in those markets, but you don't have every Tom, Dick, and Harry on trading those markets. Now, when there is strong market structure in place and the market is trading around that structure, big size is going to come into the market generally. And the reason it is because it's coming in because they're not worried about affecting the market movement. Okay? Because when you're trading around structure, that's an obvious place to trade in the sense of, looking at a screen, looking at a chart. So if you got a lot of size to move, you could move it at a point of structure. So, one, don't be surprised to see, a lot of volume come in at a structural point, because that's where people can trade, okay? But really what you want to start focusing on is, as the market starts moving away from that structure, are there signs of momentum? And again, in the later module, I will talk about specifically what to look for in terms of momentum, because what you want to spot is that momentum coming in as the market starts moving away from structure as soon as possible. right? Here, this was our low, right? We're starting to see some momentum come in here. We got our heavy volume, at our low of the day. It's to be expected. Now you're starting to see signs of momentum come in. And that's going to give you a nice, easy trade to take because, one, your risk is pretty limited because you're trading around structure. You're not trading out in the open as the market is roaming around. You're trading around structure. It's going to give you a tight stop. The low of the day, the high of the day, or where that heavy volume was just transacting around the high of the day or the low of the day. Right? Another example, right? You see the heavy volume coming in here. Then you're starting to see the momentum come in here. As the market starts moving up, it's going to give you those nice, easy layup trades. So when a market is exhibiting weak structure, big orders will destabilize price action. When prices are affected by big orders in weak structure, it doesn't just affect the trader with the big order who's trying to execute it, right? It's not affecting JP Morgan, who's trying to execute 1,500 contracts. It's affecting the entire market, everybody else that's trading around the market at that time. And, perfect example, right? As this market was just sort of trading, around the opening, this yellow line is the open price for the day, or 12 o'clock. And, a big order is coming through, but he's searching for that liquidity, right? He's not able to get it off right around, this 107.50 area. It's going to take him 20 ticks higher up to, 107.60. And everybody else that's trading around the structure sort of caught up in it because he's had to move the market to get this order executed. All right, now real trends move in the direction of strength and against the direction of weakness, right? When a market is exhibiting, a strong trend, it's going to be pretty obvious in terms of the order flow. Again, look at the volume. And when I say, strength, people automatically assume that a sign of strength is heavy volume, right? In the sense of, well, they'll say this is weak because you see the volume is getting weaker. It went from 5,000, 3,000 to 2,000. Well, no, okay? Really what you want to be looking at is the market internals. Are the aggressive traders getting stronger, or are they strong, and are they being consistently strong, right? This market was weak. You see 682 minus 615. Now you got positive 220, positive 800. That's a big sign of strength in terms of delta, right? Aggressive traders, right? And, okay, you got a bar here, small volume, 2,900. Again, not the end of the world. Delta's on the smaller side, 186. But then again, nice big strong positive delta, 752. It's showing strength. Aggressive traders are showing strength in the market. 200 minus 200 plus 183 plus 700. More strength coming into the market. Okay? So that's how you measure strength, is what the aggressive traders are doing, not necessarily is overall volume increasing or decreasing. Right? Obviously, sometimes it's a bit more obvious when volume jumps, 2,400, 3,900, 6,400. But more importantly, what's delta doing? Okay? Positive or negative, right? You can see the delta's getting, it's positive 700, 300, 188. So positive delta is decreasing. Negative delta is increasing. Again, this is one of those where it's just so obvious. You can sort of see it happening here in this turn. But this bar is just so glaringly bearish, on the back of the deltas getting weaker, then getting, weaker positive, stronger negative. The imbalance is coming in, the points of control is coming in. Obviously, the delta is big, strong negative. And for me, the last thing I'd be looking at is the overall volume here. I say, well, 6,400. Yeah, that's great. That's what I like to see. But it's not our biggest volume. Here you got 7,000, but it's coming in before this bigger, even the stronger volumes coming in, 8,000, 7,000, 11,000. Right? But by this bar, it should be so obvious already what's taking place in the order flow. So after a breakout of structure, support or resistance, watch for evidence of weakness after the breakout. If weakness is shown in the direction of the breakout, expect the breakout will fail. If weakness is shown in the pullback to test the range boundaries, previous resistance becoming support, expect the price will continue in the direction of that breakout. Okay. What do we got? Right, market's going up. Right, strong move up, healthy move up, positive deltas. All of a sudden, we got strong, aggressive selling coming in. Right, you got weakness coming into that market. Right, we went into structure, aggressive buying. Right, but it's resistance. Now we got aggressive selling coming in. Negative deltas. Right, volumes again. It's not your strongest volume here. This is 900. Everything else is 200s, 300s. So I don't want to say, one way or the other. Again, if you're just looking at volume by itself, 700, the strongest one's not till here. But you could pick it up, what's happening earlier with, the mostly negative deltas coming in here, the imbalances coming in here, to catch it before it even gets triggered here. Everyone else is watching price and, looking at bar volume, getting short in here. You could get short much higher up in here before they recognize what's happening to get short. So when there's no evidence of strength shown on approaching the structural support or resistance, we expect the test of the framework will hold, right? In other words, the existing trend will end and a reversal will start. For example, a weak delta or sequential decline, a new trend in the opposite direction is what you have to start looking for. Okay, so again, we're coming up into the high. What do you think? It's strong or weak? First time we came up into the high, we got some selling came in here, right? The negative deltas, but the selling eventually weakened. We're coming up into the high, nice positive delta, 500. Volume 1400. Next bar, again, nice volume, 1300. We got negative delta. Next bar, negative delta, negative delta. Then the delta builds up again, 10, 100, 200. You get up here, you got zero delta, just coincidence. And you're hanging around the high, but negative deltas. Make a new high, negative delta. Negative delta after the high. Okay, you start seeing some signs of bearish momentum coming in here. All right, you're starting to see some signs of supply coming in as well. Volume on the offer side. Okay, so we're up near the high. It looks a bit more bearish than bullish, right? You got the aggressive sellers. You got the imbalance. In this case, the point of control is kind of mixed, even though they are off this high, starting to go lower, right? This is the high, lower, lower, lower. I just don't like that. It's just kind of jumping around just before it. But, once we hit that high, it starts trending down. And you got supply coming into the market, right? Not only do you have supply coming into the market up in here, but you have momentum coming in here. Momentum in this bar. Momentum in this bar. What do you think the move is? It's to the downside. Now, when price is showing strength approaching the structural framework boundary, like, support, which is the low of the day, watch for a potential breakout, which is a continuation of trend. But also watch how the market is acting as we get close to the breakout and after the breakout. Are there imbalances going into the breakout? If the market breaks out and pulls back, watch for weakness in the pullback. If there's weakness in the pullback, expect price to continue in the direction of the breakout. Why? Because these are signs of a trend continuing or ending, and if the trend ends, a reversal may take place. So again, anytime we're breaking out, either to new highs or new lows or out of a range, you want to be asking, is this a legitimate breakout? Can we continue in that direction? Okay. And what do we get, right? We're breaking out. We're seeing that aggressive selling coming in. Okay. Then we pull back a little bit. What do we see on this pullback? We still see aggressive selling, right? We hit this low, bounce up. Okay. Then aggressive sellers are coming in. Then you start seeing passive sellers come in, right? How do I know these are passive? Well, I just look at the delta for one, and second step is I look at the volume, 15, 36, 24. Highest volume on the bid side is 20. Then aggressive sellers coming in, followed by passive sellers coming in. Okay, and you sort of go sideways, pull back a little bit, similar thing. What happens? We make this new low, start pulling back. We got aggressive sellers followed by passive sellers. And the market continues down. Going up to this high, okay. Structure, right? High of the day, very obvious structure point. Coming up into the high, yeah, we have the strong passive buyers, right? But what did I tell you about those strong passive buyers? It's probably institutional sellers selling into that because we're up here at structure, at resistance, right? That's the easiest place to sell, is at resistance in a rising market. And then then it's, it starts weakening. Right, you see the aggressive selling coming in here, right? We're at the high of the day, strongest, not so strong, but a very decent negative delta, right? Just as you had here, minus 124, minus 87, minus 94, minus 85. New high, more aggressive selling coming in. What do you think the market's going to do? Then it starts rallying here, okay? Starts coming back up. Okay, well, maybe it's going to take out this high or not. But it's doing it. How's the volume? It's average. A little bit stronger, 300, 156. But how's the deltas? 37, minus 12, 17. But up here, really the sign was in this delta at the high of the day. The strong passive buying, 100, 100. Even here, 153. So that's telling me that as we're going up here, there's institutional selling at the high of the day. If I know there's institutional selling at the high of the day, I don't want to be getting long. I want to be getting short. And what happens? This was the high, came off, came back up, more selling, sold off. So trends end as volatility tends to revert to the mean. Okay, think of it this way. If your wife is mean to you most of the time, then it's nice for a few days, chances are she'll revert back to the mean again. Pun is intended there. Basically what this means is that volatility will revert back to a more average or normal level after reaching an extreme high or low. Okay, so think about that, right? Not just, we always talk about price reverting to the mean, but that's just price. Right? Volatility also returns to the mean. What is volatility? Volatility is the market looking for liquidity. Once it finds that liquidity, it's sort of returned back to the mean. So with trading, right, you really got to be a detective and look for clues that the trend is ending. So this concludes module 2. I'll see you in the next module.